Good morning and welcome to another edition of our Ashworth Wealth Investor Update. We are excited to have you here with us today and have some things that we just want to go over real quick. First of all, before we jump in, I'd like to thank everyone that came to our education meeting last week. We had great brisket and a good discussion on interest rates and economy, as well as some tax legislation that's going to be impacting a number of our clients. We're grateful for those that came and supported us. As we go forward with our presentation today, the primary thing that we're looking at is just the Fed and what's going to happen with interest rates. Next week, the Fed is going to be meeting again to determine whether or not they're going to bump up interest rates or leave them the same. And interestingly enough, last March, when the Fed met, they were pricing in about a 21% probability of another 25 basis point rate hike. Right now, that has gone up to about an 85% probability. And the situation is that even though the economy has been mixed, there have been some areas that we've had some very good slowdowns. There are other areas that seem to be a little bit stubbornly resilient to what is happening with the interest rate. So it has been quite a bifurcated economy, meaning that there are different sections that are responding very differently to the increase in interest rates. Primarily, we're seeing consumption growth, or the consumer still going out and buying new products, new services, and that is probably the biggest one right now that is still growing. It grew at 3.7%, which is quite a bit higher than what they want. The overall GDP growth came in at 1.1%, so there are areas that are coming in exactly where the Fed wants, but there are other areas that are just still quite a bit stubborn in trying to get those interest rates down. So as we look at this going forward, the Fed is going to meet next week. Jobs report is still strong. It's slowing, but it's stronger than they want it to be. And it just seems like that right now, there is more than likely going to be another 25 basis point rate hike. And as you can see from this chart, one of the things that you look at here is you look at 2023 for the year, and where there are the most dots is the most likelihood of where the interest rates are going to end up by the end of the year. And you can see that they're projecting that by the end of 2023 is probably at about a 4.75% interest rate. So up about 50 basis points. If you look at 2024, you can see that it goes down to about 4.25%. If you look at 2025, it looks down about 3.25%. And then beyond that term, they're looking at about a 2.5% projected interest rate that the Fed will have at that point. So what this means to us is that as you go forward, the bond portfolio should be reacting fairly positively to this projection of interest rate decreases. As we mentioned in our education event last week, talking about short-term rates versus long-term rates, the short-term rates right now are actually quite a bit higher than many of the long-term rates. And so it allows us now to have, if you've got shorter-term money that you're not going to be spending within about 2 years, that's money that we can probably help you put to work and get a little bit better return than what you're currently getting. So that's something to keep on your radar. We don't want to allow money to just sit idle and to not be working for you. As we go forward, we'll keep looking at what's going on in the market. We'll look at where things are at, especially with the Fed next week as it comes out. And we will try and keep you informed in everything that we see. Thank you so much for joining us today. As always, if you have friends, neighbors, relatives, associates that you feel like may benefit from our weekly investor update, please feel free to forward our link to them. And with that, we'll go ahead and sign off for today. Thank you so much for joining us.